As you can see by examining the fast graph of the S&P 500, the market has historically traded at valuations between around 18 or 19 times earnings, the blue line on the graph, and 15 times earnings, the orange line in the graph. But recently, in the last couple of years, the market has become extremely overvalued, and we can see the correction is starting to happen. When you see markets like this, as highly valued as this, they become very vulnerable to any type of catalyst that could bring the market down, and the threat of rising interest rates, as well as the political uncertainty that's going on in the country right now, lead us to believe that the market could generally correct. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. Welcome you to part 7 of my series, where I'm looking for value in this marketplace by going through all the 11 sectors based on GICS. And today I'm going to be covering the industrial sector. And I've run these screens looking for value in this overvalued market. And as I, depicted in the first slide or the first fast graphs on this video, that the market itself is extremely extended and very vulnerable to corrections, but it is a market of stocks and not a stock market. So here, let's go turn to fast graphs and let's look at my screen. I've run 11 screens here, and I've got 12 companies in the industrial sector that I consider to be either reasonably priced or approaching reasonable prices out of all the industrials that I covered. So we're going to go through those. I've created them. I've created a value portfolio here where we can look at these according to value. Now, I'm looking for earnings yields above 6%. As you can see, Emcor is just slightly below that, followed by Stanley, Black & Decker, which is just above it. But these are the companies in the sector industrials, and these are the subsectors. I've got construction and engineering, industrial machinery, aerospace and defense, research consulting services, agricultural farm machinery, air freight and logistics, building products, trading companies, and distributors. So I've got a broad section here of diversification among this, overall broad sector, the industrial sector. So let's look at these companies one at a time, if you will, and pointing out that, as we saw with the market in my first slide, it was extremely overvalued. But here, as I look at these individual constituents, you can see that they're attractive. Now, Agco is a company that's agricultural, farm, and machinery. These are going to be high-level coverage of these 12 companies. So obviously, in one video, I don't have time to get into an in-depth analysis. I'm going to leave that up to you. But I do want you to basically know what these companies do. So, they are farmer-focused solutions to sustainable world. News and Center, this is a company that provides all these different products for agricultural. So this is the first company here, Agco. And what I want you to note is how closely the stock price has tracked earnings over time. The company is somewhat cyclical, as you can see, and they started paying a dividend in 2013. They paid a $4 special dividend in 2021, and the company currently has a regular normal dividend yield of 0.67% and an earnings yield of 7.65%. So it looks very, very attractive at a blended PE of 13.06. The company's BBB- rated. But you can see that, how the market misappraises stocks from time to time. It gets undervalues them, overvalues them, undervalues them, overvalues them. And now this stock has fallen into attractive valuation territory and even offers a margin of safety. So that's the first one on the list, Agco. The second industrial is Cummins, the diesel manufacturer. Best known for, you can see again, the cyclical nature of the industrial. Industrials tend to be somewhat cyclical. You can see how the stock price reacts to that cyclicality. And you can see times when the stock is very inexpensive, times when it's very inexpensive. And obviously you want to be investing in stocks like this, especially these cyclicals, when you have a really strong margin of safety. Cummins has fallen from being highly overvalued in the beginning of last year, and it's entering this year now at a reasonably attractive valuation. But again, there's no margin of safety. So this would be one that I would be looking to buy it a little cheaper. Now, according to forecasts going forward, we do have a modest margin of safety in the stock looking forward. So There's Cummins, the diesel manufacturer, 2.59% dividend yield, blended PE of under 15, earnings yield of 6.81%. I like this company a lot. I'm long this company, but I bought it at much better valuations. I would look for a better margin of safety before I bought Cummins, personally. Next one on the list is Emcor. Emcor is construction and engineering. It's got cyclicality built into it, but it's really been more of a growth stock since coming out of the Great Recession. You can see how the stock price reacted very dramatically during the pandemic and then how it quickly recovered, and it's now moving back into fair value. I do consider this one slightly overvalued. The earnings yield, as I mentioned, is 5.86%. Dividend yield is less than 1%. PE is currently 17, but it looks like it's beginning to come into fair value. So this is one that you might want to be watching for the future as an industrial, but in light of how expensive the market is, it's an industrial that's, really not that overpriced. If you're not familiar with this company, a quick look at the website, you can see that they have construction services, building services, industrial services, and you can go into the website on your own and learn a little more about this company if you're interested. But I would be waiting for the stock to get more attractive before I would be interested in investing in it myself. FedEx is very interesting, just almost a perfect correlation between market price and the historical operating results of the company, which is the orange line on the graph. You can see how when earnings turned down, the stock price followed it, and you can clearly see when earnings turned up, the stock price has followed it. You can definitely buy this today with a margin of safety at a blended PE of 12.3, earnings yield of 8%, dividend yield of 1.2%, and we are expecting double-digit growth going forward, so I consider this one very, very inexpensive. And again, I think you all know who FedEx is, so I'll spare you going into their website. But the point is, I think that long-term, shipping and online sales and, creating a great business for FedEx going forward. So, we are looking at 11.69% growth over the next 2 or 3 years, and you can buy that growth at a very low value PE of 12.31 with an earnings yield of 8%. So there's FedEx for you. The next one on the list is Huntington Ingles. It's a aerospace and defense company in the order of Lockheed Martin and General Dynamics, et cetera. You can go into their corporate website and to see that, artificial intelligence is a big deal for them. You can learn all about the company by going into their website, but it's not as well known as General Dynamics and Lockheed Martin and some of the more prominent ones, but you can see the relationship between earnings and market price. You can see how the price always comes back to fair value when it gets disconnected, either over or under. The stock is expected to get good growth going forward. Estimated growth rate for the next couple of years is expected to be relatively slow because of a negative year this year, but then it's 4.5%, and then it's expected to grow at 22% or 21.7%. in 2023, so you might want to watch out for this one. The growth is in the future, not in the past here, because the past has been a weak year in 2021. Dividend yield 2.41%. You can buy it for less than 15 times earnings with an earnings yield of 7%. Modest margin of safety relative to the future growth, but again, it's BBB minus rated. It's one that is inexpensive, or at least reasonably priced in today's very overvalued market, as I've shown you. This is Itochu. I'm not sure I pronounced that correctly. This is, if I remember, it's a Japanese company, so it's an industrial that I thought I would throw in here. You can translate the stock into English by going into their website and learn some more about the company. But let's take a look at the fast graph on it. You can see it's quite cyclical. There are periods of time where it goes several years of down earnings, followed by several years of up earnings. Earnings have been up and down, expected to be actually down this fiscal year, then, rising. The sellable feature here, and this is where you want to use this tool correctly and shorten the time frame so you get a better perspective of what it looks like. The company does look like it has a margin of safety, but there's a lot of issue in here, and I want you to be thinking about that. When you look at a stock like this, if you're going to be getting earnings reports where earnings are dropping, that could have a clear effect on the stock price going forward. As an investor, you should be aware of that when you're looking at stocks, that, what does the future look like and how certain or uncertain is it really going to be. You can take a quick gander at their analyst scorecard and see that the analysts have got the forecast of this company wrong several times. So that's another thing that I would be concerned about when I was looking at this company. But anyway, it's trading at a blended PE of 7.8. Dividend yield is just under 2%, 1.91. Earnings yield of almost 13%. and the company is A-rated, however, but a rather spotty cyclical record historically. Looking at Leidos Holdings, this is kind of an interesting company. It's in research and consulting services. Again, this would be one that if you're not familiar, as I wasn't, you can go into their company's website and learn a little bit about, what the company's doing. They do provide cybersecurity for all types of government agencies and so on. You can learn about it more on your own by going into the company. What I like about the company is since 2014, they have a January fiscal year, the company strung together a pretty good streak of earnings growth here. You can see it. It's averaged almost 23% a year. The stock has historically traded around 17 times earnings over that time frame. You shorten the time frame a little more, the earnings growth has slowed down to 11.76. That's still very good. The stock currently trades at 14 times earnings, 13.96 to be precise. Earnings yield of 7.17, dividend yield of 1.55%. It's BBB minus rated. It's forecast to continue growing at about 9% a year going forward. It does offer a modest margin of safety based on the fact that its valuation is so low. So this is one that you might want to take a look at for the future as well. If you're looking for a decent dividend growth, the dividend hasn't really grown that fast, though, in recent times. So that's something to be, cautious of. They've maintained about the same dividend range for, several years over this time frame. But that's Leidos Holdings. Next stock on the list would be Northrup Grumman, which is another aerospace and defense company, very similar to what I showed you earlier. Blended PE of just over 15.77. Earnings yield's a little light. The company has rallied since I first ran this screen. Offers a 1.5% dividend yield, but again, you can see it's reasonably priced relative to the overall stock market. BBB plus rated. This would be one that I would be, watching out for if I could get it a little cheaper. It's actually up in today's market, I believe. Let's see what it is. No, it's actually turned down. It's down 1.67% in today's market. So it was up yesterday. It was up about 1% yesterday. Anyway, that's Northrop Grumman, good aerospace and defense company, pretty well known. This is Owens Corning. Owens Corning is a very interesting company, in my opinion. You can see that their dividend record is modest. If you look at their past performance, they've grown their dividend at about 7% a year. They started paying a dividend in 2014. And so if I, bring this back to that time frame, you can see that they've had very, very strong growth there as far as earnings go. The PE's averaged about 15 times earnings. You can buy it today at 10.4 times earnings with a 9.58% earnings yield and a 1.52% dividend yield. The company's BBB rated. I think this stock has very interesting attributes from a standpoint of a really strong margin of safety. It's got double-digit 15+% growth going forward. I would take a hard look at Owens Corning if you're looking for a dividend growth stock that can give you some total return on top of the dividend growth. Snap-on Tools is one that I've written about or blogged about or videoed before. You can see the relationship between earnings and price over time. It got very, very inexpensive during COVID and then rallied to where it got overvalued. Now it is subsequently corrected and it's really trading at its fair value line now. It's a 14.5 blended PE. Earnings yield of 6.9%, dividend yield of 2.69. And this one does have a very strong dividend growth record. It's been growing their dividend for the last 10 years or so at about 16% a year. So that's something that you'd want to think about looking at the stock. It's fairly valued now. It's not cheap. There isn't a margin of safety. But if you could get this stock cheaper, I would suggest taking a hard look at Snap-on. It's A- rated. It's one of the higher quality stocks in the list here. And again, you can see the effect of overvaluation is something important. These were not good times to be buying the stock. These were good times to be buying the stock, as it is with all stocks. Stanley Black & Decker is another one that's beginning to come into fair value territory after becoming overvalued for much of 2020 and 2021. It's now moving back into alignment. You can see a very high correlation between price and earnings. You can see how when it got overvalued, how it corrected. That principle, I keep repeating that, and I think I may be saying it so much that people are ignoring it. When you see high valuation like this, it's almost inevitable that the stock's going to get back into a fair valuation territory. And that's something you should watch for when you're looking at any of these stocks. Again, I consider this one in the fair value range, but it's fully valued as fair value. It's expected to grow double-digit rates going forward, which I like very much. So if you could get this stock at a lower valuation, it would be one that I think you'd be wise to consider. Triton International is a trading company and distributor. I'm not real familiar with this stock, so we'll go quickly into the company's website. They're the world's largest container leasing company. And of course, we got the supply chain issues and everything going on today. I think this might be why we're seeing a flattening of earnings expectation. But historically, this has always been a relatively cyclical company. Its dividend record is very spotty. It raises, it's not afraid to cut their dividend. Let's put it that way. They've cut the dividend several times in their history. The statistics show a blended PE of under 7, dividend yield of 4.25%. But again, it's a dividend that's been cut several times in the past. Earnings yield of 14.75. So you might look at this as speculation. Earnings growth rate is expected to be modest. Actually, in the next couple of years, it's even expected to be negative in 2023. So make sure you look at all the data. Don't just look at the numbers. Look at all the data as you're evaluating these stocks that I'm showing you in this graph. So there you have it. Those are the 12 stocks in the industrial sector that my screen has brought up. They're kind of diversified. They're definitely inexpensive when you put it into the context of the stock market. So anyway, this has been Chuck Carnival saying thanks for watching. Hope you enjoyed this part 7 of my series of 11 videos where I'll be covering every sector and looking for value in this overvalued market. If you enjoyed this video, ring the bell, give me a like, give me a thumbs up. And of course, you might want to take a hard look at fast graphs. They really give you a great perspective of what kind of business you're considering investing in and also what kind of value. Like I always like to say, we don't dictate value on the fast graph tool. The fast graph tool reveals value and allows you to make more rational long-term investing decisions. Thanks for watching.